Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Monday, February 3rd, 2025. It's 10:34 a.m. Eastern Time as I'm starting the video. We'll keep it brief. There hasn't been a lot to post today. We had a nice gap down this morning. But my thoughts have been conveyed. The levels are the levels. That's the main thing, and I want to talk on that for just 1 second. A lot of buzz in the comment section today about Trump and the tariffs and Mexico and Canada and what it's going to mean and how long or whether if the tariffs are going to be repealed. Look, it's great to discuss that stuff. I love and I'll chime in too. And I did on one of the comments. I'll give you my 2 cents. These are obviously just short-term tools, and these tariffs will not be imposed permanently. A lot of things aren't going to happen that's being talked about right now. That's my strong take. When you talk about, especially Mexico, I make a comment there. I can tell you firsthand, I've had a couple $100,000 of probably about $250,000 of work done to my house in the last just over the last 2 years with the 3 hurricanes that we had hit. Not to mention, actually, take that up, add another 100 on another big major project. So many projects, many workers. I can tell you firsthand, and I know from talking to other people, this is not just a regional thing. They're not going to get rid of all the migrants right now. It's not going to happen. If it happened, it would be utter and catastrophic failure of the U.S. economy. So again, I said in the comment section, I've talked to many of these migrant workers that come to the house. I've watched them work. I've hired them on the side from the companies, and these are some of the hardest working people with the best work ethics. And again, I've talked to contractors, many that know this firsthand, and I've read. You're just not going to get, I don't mean to sound racist, I'm Caucasian, but you're not going to find white Americans doing the work at the price these people do. And so number one, you'd have sky high inflation. They want much higher wages. I hate to say it. Most Americans typically lazy and entitled. It's, again, whatever you want to call it. These people come from a different place. So that's not going to happen. They're not going to deport all those workers. Trump's pool would turn green, as would everybody in Congress, and the grass would be overgrown. So you want my 2 cents? There it is. So you're not going to see that. You're going to see a little bit, some restriction on the board and all that. So, and to that too, it's not just about cost to work. It's the work ethic of these folks. I can tell you, the ones that are up there on the roofs when it's 95 degrees outside and 130 up on the roofs, they don't take 2-hour coffee and lunch breaks and smoking breaks. They don't call in sick. They show up to work. So that is my strong conviction on that. And that's just Mexico. We'll see with Canada too. We're not going to, they're talking about it today. You're going to stop production of auto parts coming through Canada. The whole entire COGS would clog up on the auto building industry. And you have more auto workers here in the U.S. than you do in Canada. You're going to shut that industry will come to a standstill when they don't have parts. So again, it's not going to happen. But I loved a good fundamental conversation. That's my 2 cents. I'm not an expert in any of these things. However, my message here is it's great to talk about. I love to talk about it. But if you start trying to trade off fundamentals, especially in something that's not your wheelhouse, and especially something that's so volatile, tariffs here today, gone tomorrow kind of thing, and you're trying to anticipate and trade around that, you will get wrecked. You will get snowplowed. Trade off the charts is my message. That's all you can do. It's the most accurate by far guide. Even though this is a very fluid situation right now, I'm talking about the tariffs and everything else and what Trump's doing, the current administration. The charts by far are going to be your best guide, and also to the whatever extent possible, know that all known variables, that's the efficient market, they're already priced in, given there are quite a few unknowns and uncertainties right now. But again, by the time you read about it on TV, read about it in the papers or hear it on TV, a lot of times that's already been priced in, a good part of it at least, into the move of whatever it is that you're going to be trading. Okay, hard stop on that. So again, the levels are the levels. This is my 60-minute chart of NQ. I did an extensive video on Friday kind of showing you the similarities between the last market top in late 2021, beginning of 2022 to now. You have the levels where we're at. That was that deep seep gap. They just cleared it perfect. This is why I love it. You've heard me talk about for years. If I think, X is resistance, even though that was my maximum bounce target, but if that's it, my stop is here, not just above it, because you can almost, at least me, this is what I've learned from decades of doing this. I learned about stop rates before we even had, electronic trading, at least to the extent that it is now, algos, high frequency trading. That goes back into the days before electronic trading, the market makers and all that. Stop rates are where they know where the stops are. So, that was exactly where they needed to go to clear out a lot of the shorts by popping the stops and suck in some longs when they took out the deep seek gap. Then the ensuing reversal, today's gap down, and here we are. So you can bounce the NQs off the level. This is support, reaction high, reactions from above, reactions from below, reactions from above, reaction from above, breakout there, right there, key level, and that's where we dropped to today. They stepped in and bought it, and now we just hit resistance where we're going to reverse. So if you are an active trader, you can ping pong these levels as long as we remain in this range. And again, I want to keep this brief because this is redundant analysis. This is the big level I've been talking about right here. This is kind of in my opinion, the lights out level, especially if it's anything more than just a little stop clearing, raid punch through. And that's about 20,660, 677 or give or take on the NQ. Here it is on a little bit longer term chart. This is my 2-hour chart. We were just looking at an hourly chart. 3 months, 60-minute candles. This is a 6-month, 120-minute candle. So this is a level I believe will do the trick. There's those 3 big reaction lows. This is, again, where we caught support today. Pretty good size move down. When you're in a trading range, as long as you're in that trading range, you can just ping pong securities. Sooner or later, we'll break. That is a thing. So, if you're a longer term swinger trend trader, especially if you shorted that, that was the bearish engulfing on the weekly of your stops there, you can sit tight. And I do think it'll go, but the thing is, I trade them probabilities, and just the probabilities go up. And then, of course, you have this additional level down here, which would be even better to see taken out. That's 20,211 right there. So again, these are your levels. There's the gap right there right now. When I talk about the gap, remember futures open on Sunday evening. So this is again, if you notice, there's a little trend here. Futures rarely ever gap down anything that's even noticeable. We go stock futures trade around the clock. They have a 1-hour shutdown period, Monday through Friday at 5 to 6 p.m. Eastern. That's it. Other than that, they're trading liquid around the clock. Nearly 24/7, or we'll call it 24/5.5, whatever you want to call it. They pick back up Sunday evening. Even then, it's unusual to see such large gaps like we've seen in the last 2 weeks. And so where I'm going, that's indicative of you usually don't see that in a bull market, big gaps, unless it's right after the end of a bear market or end of a massive correction where you have gaps up due to order imbalances and everything else and fundamentals. So that's it. So that's where we're at. That gap is the next resistance level on the 60-minute chart. Let's look at QQQ. You can ping it around there. This is the same 60-minute chart with the same levels I've been giving you. This is where the reversal came in today. Exactly where same level I had on the last week's videos, 510.43. There was a little minor uptrend line. So far, we're making these lower highs right there, but we're not making lower lows. That's, again, why this level needs to go right here, which is comparable to what I just gave you on NQ. If that level goes before these highs are taken out right here, then you have all the makings of a downtrend. And a downtrend very simply is defined on any security as a security making a series of lower highs and lower lows. That was a near-term downtrend. You had a new high there, kind of negated these two, but however, a bigger picture is than this. To hop there. Oops, trying to arrow tool it. Here we go. And so now that's where we need to go out and take out that support level I showed you, and it'll also be that recent lows. You start popping this and then this, And there's a good chance you're going to do my alternative scenario, which I'm still and have been open to, and it's not going to change the longer term charts. Again, all this has been covered. There's the divergent. This was a divergent high. You had a nice bearish engulfing on the weekly there. But any marginal, again, the operative word is marginal, meaning relatively slight. Relative is to the scope of the move of any security. So we'll, I don't want to, can't put a hard quantification on it, whether it's 3%, 4%, somewhere in that area, 5, 6, maybe 10%. We'll see. We'll see what the charts look like, the technicals. Right now, that isn't the case. We don't have that, and that is not and has not been my primary scenario. But it's something I'm open to do. How can I not be when the markets are still within spitting distance of new highs? Again, we need to, once this happens, then probabilities change. The probabilities of a new high then decrease, and they decrease pretty substantially. Until then, this is the market we have. This is what I've been talking about for months now, heading into last year. It's a trader's market, ping pong, but volatility is perking up. I just mentioned to you just last week, I told you the VIX is cheap. I think I used those exact words. The VIX looks good. I covered it in the last couple of videos. What was it? VIXY, I think. Yeah, I gave it to you even as an official trade idea. That's right. I almost forgot about that. That's it right there. What board did I have for you? Oh gosh. Oh, maybe I gave it on the I gave it to you on the daily. That's it. So we went up. Where did we stop today? We stopped right at that downtrend line. So the VIX futures, everything hit that 60-minute downtrend line right there. It shows better on the VIX futures. I'll show you in a second. So it was a logical, reaction point. And when that breakout, if and when that occurs, you can see that's going to be your first resistance there. Also, remember, I gave it to you on the daily chart. You can use those targets. 60-minute just kind of has some micro levels. I call them shorter-term targets. And here's my poison, the VIX futures. There you have this. That's that high. This is a 6-month chart, 2-hour candle as far back as I can go, but it comes in and catches that high that I just showed you on VIXY and the other ones. So you come off that high, you come in, you hit that reaction high, you hit that one. And this is not mere coincidence. That's where the market bottomed today, and the VIX pulled back so far because NQ, as I started the video, hit perfect, support. QQQ hit support, and VIX at the same time hit resistance. This is, again, when you're active trading, if you can see all those, especially in SPY come in. I didn't even check SPY, but imagine it hit a support level. Today's lows are close to, if not right on. And that's it. So pull back, and this is all I can tell you right now is if and when we get a breakout here, especially if it's impulsive, that's going to increase the odds we go much higher. I'm going to add a little level right here on, I'm going to put it actually official. I want to see that because that's, I can see a few stops around there, a few reaction highs, give or take, around that level, including this one. So, and again, it's a trend line, really. You pop the trend line with conviction, you're going to go up and hit these targets. And then I think the VIX has a potential to let loose. This is only a 60-minute chart. That's why I've covered with you recently the VIX on a daily time frame. That's, my upside targets, if the markets break down, lose that support, are measured into the into the triple digits. That's 100+% gain potential in the VIX. And if not, no breakout is not going to happen. You got to break out. That's it. So appears likely and imminent. This is just the divergence I've been harping on here continues to build. This is positive divergence. You have lower lows and then equal lows with higher lows, and this is what you need. You either have to have lower lows in prices and equal or higher lows on the indicators, or you can have equal lows in price with higher lows on the indicator. Either one, those are both all one and the same divergent low, aka positive divergence. So that's it. Don't want to beat a dead horse. Those are levels to watch. The only other thing I would point out today is NVDA has now given up the 200s. The day is young. The week is very young. But if we close the week solidly below there, it will help to see close the day. This is what I'm talking about for a while now. 1, 2, 3, 4, 5 days testing the 200 days. Those are the blue and red lines, simple and exponential moving averages. That is clearly a breakdown. Now the day again is young, but that's taken on face value until unless it reverses. That's we have now NVIDIA the top dog, or it's number 2, I think now behind Apple. Yep. Actually, dropped down to number 3. It was the largest a little while ago, and it's been leapfrogging with Apple. Apple, that perfect, beautiful breakdown, number 1 there, back test. Then primary trend line breakdown, I should say, bounced right off the 200-day moving averages after same thing like NVDA tested them for 4 days, rallied, back test against the wedge, fell. So Apple also has to take out the 200s. And so Microsoft has now, it's trading below. Remember, Microsoft's been kind of making a few little brief punches through, but it won't go lower until the rest of the Mag 8 breakdown. And so we now has NVIDIA, the most important of all. I rank them as NVIDIA number 1, Apple number 2, and I'm not talking market cap. That leapfrogs. I'm talking psychological importance. NVIDIA is unarguably the poster child of the AI bubble. So when the king dies, the general, the 5-star general gets taken out, the troops are likely to, lose the battle there. So again, we'll see how the week closes, how today closes. Like I said, this fluid thing. Always say the charts are dynamic, and therefore so is my analysis. But as of now, we have NVIDIA, Microsoft below their 200-day moving averages. Still plenty of room on Alphabet, of course. Plenty of room left on Amazon. First things first, you have these minor, the trend lines, price support levels that need to go to get you there. Meta still comfortably above the 200. So most of them, and Tesla. And then rounded out, if you want to call it the Mag 10, Broadcom, also above there. So again, you can't get super duper bearish or super duper short, especially for what do you call it, a non-active, a typical swing or trend trader. You're going to need to wait to push it really hard. You're going to need to see the majority of these FANGs or Mag 8, 10, whatever you want to call them, below those 200s. Otherwise, the possibility and probability even for new highs is pretty decent. Okay, just to follow up on the other comments, I answered most today. This one I didn't answer. It wasn't a question. It was a comment. Somebody said EATZ has gone parabolic. EATZ I listed as a short trade last year heading into the end of the year. I gave you 6 price targets. The sell signal to come here on a break of the trend line. We got that. We hit my first target, and then we hit it again. We bounced. Remember, my targets are support levels. Support is support until unless broken, I always say. And the other thing I always say is the reason I list multiple price targets is that upon the initial tag of each one, a reaction is likely. So far, that's all that is a hit of the first target, another hit, a successful bounce off support, the typical reaction so far. All it's done to the charts is extend the big negative divergences that were already in place. These are the divergences. They start back here. We've been moving up at lower lows in these indicators. And this marginal, again, that's exactly what a marginal new high is, just ever so slightly above the other high. Pulls in, sucks out, blows out the shorts, which is what you need, to make a call that, the restaurant sector, which is what this is, EATZ sector ETF is going to drop 30%. To do that, you can't have a lot of people thinking like you. That's how the stock market works. When you have high short interest in a stock, it's hard for it to go down because you have these shorts that at different levels are going to take profits on the drops. And when you are a short seller and you're taking profits, what you're doing is you're buying the stock. You're buying to cover. You're buying shares that you never owned. You borrowed somebody's shares, you shorted them, and to close that position, you have to buy them. And it's no different from a bull buying the stock. Remember, everything works on supply and demand in the stock market. More buyers and sellers, it goes up. So what I like to see is stop blowouts, and that's what I believe that is. Again, the charts look still big divergent high, and when T1 gets taken out, that should open the door to T2, T3, T4, T5, T6. Another comment was about natural gas. I answered that. I posted a chart. I'll show it to you. Let me grab it. Okay, this was it. Shared it this morning. Remember, this is an EOD chart. When I go on long term, I like to use stock charts here. This chart, weekly chart, and this is a chart I've been covering quite a bit since last year, highlighting all these divergent lows on the weekly chart. and telling you what the average gain. You may not see it in the video. I'll read it out: 223%, 106, 160, 240, 207, 563, which easily gives us an average north of 200%. And so far, we're only from that divergent low I highlighted last year. Those are long entry, sticking with it. Only gone up about 155. So we're below the average. And this is, as I mentioned also, as I've talked many times, much larger. The divergence is larger in scope and magnitude compared to a lot of these other divergent lows. So wouldn't surprise me to see us ultimately go past my price target and go even higher, especially considering we're we haven't, the Fed tried to declare mission accomplished with inflation and then backpedaled, ate crow, as I knew they would. So we're still in the hottest inflationary environment in a half a century. So therefore, to think that natural gas can't even just go up what it's gone up on average in the last, a couple decades. So I don't think that target's a stretch. What happened? We pulled back. I had a little support level here drawn in the chart that I posted right here. You can see we have a reaction high here, these reactions as I'm coming across. We pulled back to that on Friday. This is an end of day chart. I'll update it here in a second. I haven't updated. I pulled it up this morning to screenshot and share it. And then, I could easily see us going back to, if I can grab my line tool, click, click, click. Click on them and they just don't take. There it is, the uptrend line right there. So far, we're zigzagging up. Nothing goes straight up. Natural gas, I thought when we popped that level, it might run all the way up, and it came close, but we put in that divergent high on the 60-minute chart. But you can see along the way, you get these corrective waves. And some of them take longer than others. Some are pretty quick. Here's one. The corrective waves are relatively quick. Even here, you have big sharp pullback right there before that final thrust up. So that's how I'm viewing this. Let me see if I refresh, if it's going to show me today. No, we're still, of course, Friday's closed. We're not until the end of today. What am I doing? It's an end of day chart. But we are up today. We're up about 10%. It might sound big if you don't trade natural gas, but that's normal. Natural gas typically goes up high single digits to even double digits in a day. And remember, we're coming off, that was the divergent high that gave us this corrective wave right down to that uptrend line. I believe I gave you this one last week. There's the primary uptrend line. This is a 6-month chart with 120-minute candles. And there's that support zone right there. And there's the bullish falling wedge right there. And this is today's breakout. And so if we can just put this 285 level clearly in the rearview mirror, we should run. Give you one little next resistance level I see overhead right here. I'll add it right on this chart. I might have it on my 60-minute chart right around there. You've got a little reaction high there, reaction high there, reaction low there, a couple reactions in that reaction high there. So that's about 3.54, 354 or so, maybe a little hiccup, and then boom, we pop those highs. Right now, the shorts are feeling pain. I have little doubt that with this recent downtrend, you got a lot of bears on board shorting nat gas, and that's probably they'll continue to get squeezed if and as we go up higher, and especially if we can punch through that 354 level. And somebody asked me about XLF, the financials. Absolutely. I was going to mention it last week. I know I've been watching it very closely. Of course, that's been one of the strongest sectors recently, especially those that move the needle on the S&P 500. As I mentioned, there is virtually no or very little, if any, weighting of financials in the NASDAQ 100. But it is one of the largest sectors in the S&P 500, so keep that in mind. And that's one reason the S&P 500 recently made new highs, while the NASDAQ 100, tech-heavy and financials lacking, didn't. But the video I did on Friday, since it was long enough as it was, I was doing comparison of two different, the market now and the market back in late 2021. I didn't want to get sidetracked. If I did, I'd be covering, I could sit here and talk charts all day. Commodities, bonds, gold, metals, crypto. But I kept that limited to the markets. But this is what I saw, and I posted this chart. There's a uptrend line right there that comes off the key August 5th lows. It was nice support. We covered all shorts, went long there back, and that was when the stock market had a bigger correction, mostly tech. And that's a key uptrend line that I've highlighted for months now on many stocks, individual stocks, the key sectors, and the major indexes. And so you can see it comes in, you have lots of nice clean reactions. You have a breakdown, back test 1, back test 2. I always say the thing about back testing, and when you're shorting a back test, you have to realize the problem with that is you can continue to back test as XLF did here. There's an example. Well, actually, no, we didn't back test till right here. That was day 1, 2, 3, 4, 5 days. So you back test higher and higher every day. And what I always say is I like to see that rejection after you back, whether it's a single back test and you get a rejection, or you back test for a while, but then finally that's a rejection candle right there. Financials, this is biggest down day at least in the last couple months, and that's clearly a rejection following the back test. And it's just like the stock market, like I said, all it didn't take out the divergence we already had in place back at that previous high. It simply extended it. So sometimes you break down, you put in a divergent high, you break down, and you never look back. Every trend has its counter trend moves, but sometimes after a breakdown, you get a little kickback rally, quite often to backtest an uptrend line, and then the move continues. Now, if we move a lot higher, let's look how the charts, talk about the charts being dynamic. You keep moving up. Well, first thing you do is you regain the trend line, and that'd be hard to spin as anything but bullish. That certainly wouldn't help the bearish case. And if you keep moving up, then you start taking out previous highs in the indicators, and you no longer have negative divergence, and then maybe something else is happening. But right now, what has happened, I can say definitively. What may happen, I cannot say definitively. Nobody can. I can say definitively what has happened, and that is a divergent high with a bearish engulfing candle back then as well that day. But breakdown, back test, rejection, and remember, after the first divergent high, then the breakdown, all we did is, I had this purple box here. All we did is backfill. That was a massive gap. Gap so big and prominent a blind man could see it. And there was a typical gap backfill. That's where they bought it, as they often do. Once you enter a gap, it's usually backfilled, and then traders will buy the bottom of the gap, and that's it, especially in a bull trend. So now that, if you want to know the magic number right there, that level needs to go. I'm going to color it up. Let's make it yellow. So kind of color coding yellow lines right now on the big levels. When that goes, then you have the 200, you can see my price support levels. 200-day moving averages also come in there. That's going to be your next target. And that'll be even more bearish longer term. I've been talking about this for months now, that, calling for pullbacks to the 200-day moving averages. I did it last year. We got it. We pulled back. That was the August 5th lows. Then when you get too far ahead, I told you back then, look, even if you're bullish, you can be near-term bearish looking for a pullback to the 200. So bulls like to buy, and I do too. In a bull trend, pullbacks to the 200s. And maybe that's all XLF is going to do. However, and again, I'm talking 5 steps ahead right now. It's not going to happen today or tomorrow. Probably not even next week. But when those 200s are clearly taken out, then that's going to open the door to a much bigger drop, and likely tell you or help confirm that we're in early stage bear market action, not just correction mode. A pullback to that level, just like that pullback to $47 right there, was a correction, as would be a pullback to the 200-day moving averages. We take out the 200s, and then this is just a lights out level right here, about 40.66 on the financials. And turn to a weekly chart, you can see it there, right there. I have it about 40.27. And so this is my weekly chart on XLF. It makes things a little more clear. There's your uptrend line, key uptrend line off the October of 03 lows. This is the minor trend line I just showed you off the August 5th lows. There's that breakdown back test. So we go here, break that more significant primary uptrend line. That's going to be a powerful sell signal, especially on a weekly basis. Take out the 200-day moving averages. I'll put more emphasis on the uptrend line. Some securities behave better to the 200s, usually tech stocks and tech-heavy indexes like the NASDAQ 100, even the S&P 500. XLF, you can see, has kind of been through there quite a bit lately. So I put a higher emphasis on this, the uptrend line. And then that would be my first swing slash trend target all the way down there. So that would be a drop of about right now about 21% in XLF. Before the upcoming or next bear market is over, whenever that is, we'll come and test at least these bull market uptrend lines that come off the late 2009 lows in most securities. And that's going to be a drop of about roughly 50, right in line with what my targets I've been calling for a while now, for about a 50% drop in the stock market. And that's probably where XLF is going. Again, nothing goes down straight down. So even if you don't like short selling or don't know how to do it, or for whatever reason think it's anti-American or whatever, there'll be plenty of very powerful, beautiful counter-trend rallies to trade. That's why I love trading bear markets. They're just so damn profitable. You make so much fast profits on the way down because things fall fast, and then on the counter-trend rallies, huge gains to be made to catch those bounces. Okay, so I already covered natural gas. Let me just hit a few commodities and maybe talk again briefly on treasuries. Told you, really Friday it was, closed out my treasuries. I'm not ready to short those yet. They still might have a little more upside. A lot of times I say that because a lot of times I close something out and I'm confident enough that's the end of the run. I'll reverse that trade, go the other way, long or short, but not there. Let me start here. Crude futures, I gave you last week this bullish falling wedge pattern, the trend line there. The positive divergence, that was again following that divergent high and that trend line break. Watch, rinse, repeat. Bullish falling wedge, bearish rising wedge, bullish falling wedge at support. Hit support. We popped it on, was it Friday or was it last night? Either way, I added these targets. That's 75.18. I had a level there, a little higher, but I see now enough reactions. 1, 2, 3, 4. Come back here. These reactions. And we hit that today, pull back, and we're right back to where we started. So we're pretty much back testing the trend line, maybe a slight hair below it. And then you have this support zone right here. Wedge could go a little lower. So if we do get another run up, we've already hit that once, but it would still be a target. That's 75.18. If we pop that, next target 76.17. And we'll see if that one plans out. Sooner or later, if the stock market does break support, thing is, I've seen corrections start where crude keeps going for a while. Ultimately, crude will succumb to demand destruction if the stock market really rolls over, but that's not been the case yet. So I just wanted to give you that update there. I already gave you natural gas. Let's talk about the grains real quick. Wheat is testing that level right now, that key 503 support. Remember, it was support. We had that couple false breaks below, and then we've been basing here. This is the daily chart. That was a downtrend line. I was waiting for that breakout. There was our bullish falling wedge, big divergent low. And so if we pop that, that should take us up to 550. You can see all the targets here. I think I also gave you 60-minute targets. Yeah, I did. These are still one of the same trade. We've been in and out. That was, it's hard to see, T2, T1 back here off that divergent low. Popped up, but we had a divergent high there that ended that run, gave us a correction back to where we started. And so again, these are still the longer term targets up here. I still maintain, but we need to pop that level. Again, it showed pretty clearly here. This is it. So you can see right here, support. Then we went in this little basing pattern here. So if we can pop that, wheat should run. And of course, it's a sister trade to corn and soybeans. The grains tend to move together. Corn's been moving up. Like I said, I expect and have seen quite a few days wheat starting to play a game of catch up, but corn needs to pop that recent high as well. And then soybeans, SOYB, again for your ETN traders, these remain the targets there. So those are looking good. What else? Let's just talk treasuries real quick, and then I'll try to wrap up here. TLT. We still have that potential, and you see it here on the daily, potential inverse head and shoulders bottoming pattern, and that could pop and play out. Again, that's why I'm not shorting it. I for other reasons too. I just wanted to free up some more dry powder. That's why I took profits on that trade. But like I said, I covered it before. I'm going to cover a couple levels in case you missed it. I did cover this last week. Why? This could be just the end of the run on this counter trend rally here. So you do have this bearish rising wedge pattern. little whipsaw down there today. So we're still in it, and you have that negative divergence. It's that 60-minute time frame. This is my go-to swing trading time frame. And that was the last divergent low. We had a divergent low there. We had a divergent high there. It's not marked as such. I'll just borrow this one. It's identified with the lines you can see there, negative divergence. And that's it. This is how we swing trade. Divergent high, short it down, divergent low, go long, divergent high, sell your longs, go short, divergent low. So that's that. Let me show you the 10-year, which is the more important of the two bonds for the stock market. That one has broken below its uptrend line on the 60-minute chart. We're still in the orange zone and have been. I pointed that out when we entered the orange zone back here. I told you, just like I did early last year, I've been doing this since last year. That's where these zones go back to. Well, at the beginning of 2024, I have to go by a 2-hour chart. That's where the stock market really starts to take note of rising yields. And it certainly has. That's why we've had this volatility lately. Just be clear, this is not mere coincidence. Sure, you can blame it on Trump, you can blame it on the elections, you can blame it on whatever you want, but they go hand in hand. The technicals and the fundamentals always go hand in hand. The technicals are the more accurate predictor and will often precede the fundamentals. And though it might seem like a fundamental news bit that's released is the catalyst, it's usually just a catalyst to trigger the breakdown or the breakout, the bearish breakdown or bullish breakout on the charts on a pattern that's already been developing. And so there's IEF. Now, yields have been falling lately, and that's why we were long treasuries, and they could break out, and we could go up, and there would be falling yields. And as I've mentioned before, that can be bullish or bearish for the stock market. As I've talked about before, any advance due to a strong stock market sell-off, advance in bonds, meaning bonds up, means yields down. If it's flight to safety, that's net bearish, not bullish. Other than that, if it's just organic and yields start to fall without any risk to the stock market's doing well, then yeah, that would be net bullish and could support, certainly, especially if we get back in the green zone, that could support the case for new highs in the stock market. So all we can do is watch these levels and position and react accordingly. And then I think, yes, I did. Last week I showed you what the yields look like. And there's a 2-hour chart, but here it is on a daily chart. So this is the 10-year bond, the yield. TNX is the yield of the 10-year bond. Beautiful little uptrend line. We're just starting to crack it, but we're close enough on it and support that I'm not going to consider that a breakdown yet. If we start to move below there, that means yields are falling and then bonds are going to continue to rally. So this is one reason right now I close my position. I'll wait to see how this resolves. If we do this, that means bonds are going to fall, yields are going to have another leg up. This trend indicator right here, as I've covered right here, the purple box is really the zero line on the PPO right here, the dashed line. Says when you are above it, when the PPO, the 9 EMA, the white line, which is the signal line, the last of the two to cross, when that is above the zero line, the trend is bullish. You want to be long and strong. When it crosses down below, as it did here, it's bearish. And when you're below it, as you were all throughout here, the primary trend is bearish. You want to be short. When it's above, it's bullish. Right now, we're still above. That means yields and the PPO, additionally, it's not just as simple as it being above or below. That line often acts as support when you're above it or resistance when you're below it. So if the PPO turns up here and bounces, that's going to keep this uptrend in yields going, which is quite bearish for the stock market. And then we could even get into my red zone where the market freaks out. So I will tell you, I'm leaning towards that scenario right there. So although I am not currently short treasuries, I may be soon. And if they rally, I'll just sit back, play it. I'll decide whether I want to jump back in long. But right now I don't. So basically, I'm as far as that goes, unhedged. For my swing shorts and trend shorts. Multiple accounts, active trading account. I'll trade actively, but I told you in the Friday's video, I'm going to stay short, go home short in the weekend, which I did on all accounts. And so I'm going to keep that primary bearish bias, which was up until recently indirectly hedged by Treasury bonds for the reasons I had stated before. So I've kind of removed those indirect hedges at this point in time, and we'll continue to actively trade my active trading account, the NQ futures up, down, and then still maintain a short bias, waiting certainly to add and take it to very aggressive short if and when those levels I covered in the beginning of the video on the NASDAQ 100 break. The only thing I didn't cover in this video, and then we'll wrap up, I'm kind of going out of order, but is the small caps. The small caps, IWM, have now broken back below. This is the primary trend line off the October 2023 lows. Primary uptrend line. We broke it there. At the time I addressed that, saying, take that sell signal with a grain of salt, because a lot of eyes will short that breakdown, but you had the 200-day moving averages, those beautiful 200-day moving averages just above, and that's exactly what happened. They stepped in and bought it, as they always do in a bull, not always, but usually do in a bull trend. And so those are the levels that need to go. So, however, that trend line is still significant, and I wanted to point out that we clearly took it out, but we're back testing right now. So we're at a key level where if IWM can pop on through here and then pop that, that's going to be bullish. If it can pop this minor, I'll tell you where it is. It's about 230 right there. It's this minor. It's where the rally has been capped on numerous days. I mean, 1, 2, 3, 4, 5, 6, 7 candles rejected off that level in the last 9 trading sessions, not including today. And so that's bullish. Near term, there's still this trend line that could get back tested and rejected. However, that hasn't happened yet. We'll talk about that if and when we get there. Right now, we're back testing this trend line from below, but we're still above the 200s. And when you look on the 60-minute chart, you can see this is a swing trader's world here. Active trade, divergent low, go long, divergent high, go short, divergent low, go long, divergent high, short, divergent low, divergent high, short. You can see all the divergent highs marked, divergent lows, divergent high, divergent low, divergent high, another divergent high, divergent low. I'll have to borrow one of these, copy it, duplicate right there. And, and of course the most recent divergent high right here. So what you can see if we zoom into what's happened most recently, you had this downtrend line off the highs. You had a breakout last week that rallied, went right into resistance at 230, price resistance. And with this line right here is your divergence line, negative divergence. And that caused that breakout to fail, which is bearish. And we're below the downtrend line off the highs right now. And in fact, we're at resistance right there as well. There's some pretty nice price resistance. Again, this is a level I've had on this chart here since December 13th right there. And that's what we're exactly at right now. And so there's the story of IWM. Just like I started the video, NQ has bounced back to resistance, offer an objective new short entry, add-on, re-entry. IWM offers an objective short here, as would it on a push to the trend line or this level, but not above, up to 230, not above, at least not for an active trader. At that point, you'd want to sit tight and have a stop somewhat above in case this thing wants to run up to new highs. All right, I will wrap it up here. This has been Randy Finney with the Right Side of the Chart. Have a great day.